Okay, welcome to part two. So as I was saying, we have that adjusting entry that is going to increase our interest expense, and it's also going to increase our interest payable. So that's the standard adjusting entry that we would make at any time because we're at the end of the fiscal period. We need to record what happened in the period that it did. And so now we're moving into our next fiscal period. Okay. And we know how to calculate this, but this is just a refresher course that you would take your principal times the interest rate times the fraction of a year, which is 30 days divided by 360. That's how we get that 71084. Okay. So we can see a couple of our T accounts here and how that's happening. Okay. We have our interest payable going up with a credit, interest expense going up with the debit. Here's our new balance of interest expense. We'll be referring to that shortly. Okay. So after posting, remember that interest payable is going to appear as a current liability on our balance sheet, this guy right here. The credit balance is the accrued interest, remember, that has incurred, but we haven't paid it yet at the end of the fiscal period. And the new balance of our interest expense, which is that $18,347, that's going to appear on our income statement under other expenses, because remember, it's not an operating expense. We aren't using any of this to make revenue for the business. It's just it's kind of like a side hustle, right? It's another expense separate from our making money for the business. So just like we did before, we would do a closing entry, a regular closing entry. So interest expense is going to be closed. Okay, here's our closing amount. That's that total, $18,347.10. Okay, it gets credited, which brings the balance to zero. Okay. Now, adjusting entries for accrued expenses, remember, same as they did for our accrued interest, have an effect on transactions that are going to be recorded in this next coming fiscal period. So remember, our company had to make monthly payments to decrease our balance of the debt that we have. So we have to pay that interest of $710.84. However, remember that part of that was already accrued in the last year. So we need to do a reversing entry again to make sure that we record everything properly. Okay. So our reversing entry is the opposite of the adjusting. So that means that we would debit interest payable and credit interest expense. And remember, that seems funky because interest payable has a normal credit balance, but it's going to end up having a debit balance for a short period of time. So as I already said, what this is going to do is it's going to create a credit balance in interest expense, which is kind of funny, okay? And that account will eventually end up with a zero balance. Also remember that interest payable gets reduced to zero because when the interest is paid, no debit entry is going to be able to be recognized, so it actually just zeroes itself out automatically. So that's what this looks like here. Because remember, our adjustment had a credit balance, so when we debit it right here, it ends up being a zero. Now, what happens if we don't use reversing entries at all? Because GAAP doesn't actually require reversing entries in accounting. It's not a requirement. A company can choose to do them or not do them. The reason that most companies choose to do reversing entries is that if we don't, there's always a possibility that interest could be recorded twice. Once as an adjusting entry, and then again when the actual payment happens. Just like we've seen as we've been doing these few problems, it's an easy thing to have happen, especially when you have many different accounts out there happening. You have to have someone remember to make sure that they don't double count it twice. So a reversing entry is used whenever we have an adjusting entry that creates a balance in an asset or in a liability account that initially would have a zero balance. So that's where we use reversing entries. Primarily the ones we're going to be working with are interest. Now, if you remember, we also had talked about the fact that we had this long-term note payable out there and that we were making cash payments every month for $2,433.17. That payment, however, doesn't completely reduce our debt load because part of it has to go to interest. And the difference between the total cash paid, which is this amount, that's our payment amount, we make that payment every month. The difference between the total cash paid and our interest expense, remember, which was $710.84, this is the amount that actually reduces our debt, or $1,722.33. So remember that part of that 710.84 was incurred during the previous fiscal period. The reversing entry created a credit balance and interest expense of 710.84. After the transaction happens, that remaining 710.84 is going to be sitting as a debit balance in interest expense, and then it'll eventually be zeroed out to zero. So what that actually looks like here when we do it for real is that here's where we get those numbers. Remember, just showed you that payment amount minus interest expense equals our reduction in principal. Okay. We paid cash for the monthly payment of our long-term note payable, check number 895. We pull up our cash payments journal. Okay. Our total cash credit, that's our payment. That's what we make our check out for, is $2,433. $710.84 goes to our interest expense, and $1,722, the difference between those two numbers, is what actually reduces our long-term note payable. Now, not all note payables require a monthly payment. Many of the ones that we know of on the personal side of things, like car payments, student loan payments, house payments, all of those things require a monthly payment that covers our interest always, plus then reduces some of our actual debt load. However, there are some places in the business world where you would actually pay the full amount of your note on the maturity date, and you wouldn't bother with monthly payments. However, if that maturity date is in a different fiscal period than when the note was signed, so for example, if you signed something in 2018 and the maturity date isn't until 2019, it would require an adjusting entry at the end of the fiscal period, which would then lead to a reversing entry as well. So you just have to be careful to watch whether things are happening in the same fiscal period or if they're covering two fiscal periods. Now, the adjusting entries for accrued revenue and accrued expenses have to be recorded at the end of the fiscal period in order for our financial statements to be accurate. And we know that that's super important. We know that we do financial statements at the end of every accounting period, okay? Each accrual is going to affect a balance sheet account and an income statement account. If an accrual entry is not recorded, that means both the balance sheet and the income statement are going to be wrong. Because remember that they are affecting typically an expense account, which is income statement, and also a receivable or a payable, which would be an asset or a liability and show up on the balance sheet. So in order for them to be correct, you need adjusting entries to put them as correct as possible at the end of our fiscal period. So a longer lesson this time around. Let's go ahead and head over to our work together and tackle 21-1 in Applia.